Hello, I'm Deborah Trow of Elevation Wealth Partners, and this is the Elevation Market Update. Today, I'm pleased to introduce Greg Toretti for this conversation about the financial markets. Greg is a client portfolio manager with American Century Investments. He's been with the firm since 2015 and represents the municipal bond team. He lives in the New York area with his family. Welcome, Greg.
Thanks, Deborah. It's great to be here.
Okay. Well, this year, I have to tell you, it feels like it's been a bit rough for our clients with all the ups and downs. Can you give us a brief overview of what's been happening so far?
Yeah, so it's certainly been a volatile market with a lot of political unrest and the war in Ukraine and now Israel and Gaza. So it's really important to remember that the current state of the economy is really a result of COVID and the effects we have from COVID. And to deal with that unprecedented slowdown, and in some cases we had shutdowns, the legislative branch and Congress and the Federal Reserve, they took an enormous amount of stimulus into the economy to really prop up the economy. They rolled out programs that were generally successful in enabling Americans to maintain their spending, allow most of us to keep our jobs. But the side effect of that has been inflation. So in a lot of ways, the economy is still really recovering from the impact of that spending. And now policy members at the Federal Reserve have been trying to get inflation under control. And this is a problem that's really challenging. And they're dealing with a symptom, really, or a byproduct of that spending during COVID.
So, what do you think? Is the Federal Reserve doing a good job on this?
I'm a tough, I know it's tough to be a critic. They have a very difficult job to do, and I think time will tell, right? This is still kind of playing out. But at the end of the day, like I mentioned, there was a lot of stimulus from COVID. That, to put a dollar amount around that, it was about $10 trillion if you count, what came down from Congress and the Fed, which is about 40% of our annual GDP. They have a lot of tools at their disposal, but for the most part, what we hear about in the news and what we're seeing is their attempt to tame inflation is really to influence short-term borrowing rates, to increase short-term borrowing rates. So, there's some debate by market participants whether we've seen peak rates or whether the Fed will continue to raise rates. In their own words, they've been data dependent, so they're really assessing now what they're going to do, what their next move will be, and we believe that they're going to have another rate hike by the end of the year of 25 basis points. That's obviously, again, as I mentioned, data dependent. For some context, the economy is actually really still strong. We've seen a recent GDP print of 4.9%. Employment is still relatively low by historical standards. Consumers have a lot of savings, although it's slowing. And then housing has been variable. Obviously, higher mortgage rates are impacting the housing market. But importantly, as I mentioned, inflation is still elevated. It's trending down. It's probably running a little too hot for the Federal Reserve. They do have a difficult job to do, as I mentioned. Some people might remember back in the 1970s, early 80s, inflation's really tough to get back in that bottle. So we'll see how this plays out.
Well, thanks, Greg. And so, how do you think the United States is doing compared to other countries grappling with this?
We're actually holding up pretty well compared to other countries in Europe or whether it's China. And we certainly have issues with inflation and debt levels, but when you look at other economies, so Europe is very export centric. Think of Germany, manufacturing and services, they've contracted. Um, there's amplified fears of recession risk there. You also have rising interest rates and inflation's high for them as well. Similarly, our friends in the UK, where inflation is high, interest rates are elevated to the point that they're at a 15-year high. So we believe, there's a potential for stagflation across Europe. Elsewhere, in Asia, China's economy has been disappointing, but there are concerns, that the stimulus that they've implemented is actually not enough for them to reignite growth. So another interesting point that people have made about China is their unemployment for youths has soared to 23%. So they certainly have their own ills and issues that they're dealing with. Despite the issues we have in Washington, generally speaking, we're better off on a relative basis than a lot of other areas. In fact, I think that explains why things like the dollar has strengthened. You've seen strength in the dollar up in the past 4 months. 4 months, it's up around 6%. So what we like to say in the business is we're the cleanest dirty shirt in the laundry basket. So it doesn't feel great, but we're doing okay.
Yeah. Well, thanks for helping us to get some perspective on how, the whole world is dealing with this situation. And so tell me though, what investment opportunities does American Century see for your bonds and the funds that you work with? Because that's really what your job is, right? To take all that information and figure out then what to do and what to invest in.
Yeah, a good question. As you mentioned at the start, I focus on municipal bonds, so I'll speak to that. We within municipal bonds, we look for quality companies, quality issuers with strong financials. Our experience is that municipal bond investors, your clients, are looking for safe, stable income that can be shielded from taxes. So municipal bonds are actually a really good place for those seeking those type of qualities. Their default rate historically for even the riskiest parts of municipal bonds are well below 1%. So what that means is investors are very likely to get paid back. And for that reason, we think municipal bonds are a very good place to be as we are likely to come into a market slowdown going into next year. Within the asset class, there are even safer areas that we like. So for example, we like water and sewer bonds that tend to perform well in a weaker market. People might not go on vacation as much during a recession, but they're still very likely to pay their utility bills, for example. So we're going to start also changing the duration of our portfolio. So what that means is the holding period of our bonds from shorter to longer duration, as they say. So given we believe that interest rates are at or near their peak, we believe it's prudent to sort of lock in rates that are being offered by the market today over a longer period, so we can really receive that income into the future over a longer period as well. So if there is a recession, as we expect, we believe the Fed's going to pause and reverse rates next year. So again, for us, it makes sense to lock in these rates now before they fall again, likely sometime next year.
And that makes sense, Greg. Thank you. So just so that our listeners are really clear, would you explain exactly what a municipal bond is and what that duration means?
Yeah, sure. So municipal bonds are effectively they're loans issued by states and local governments, and over the life of that loan or that bond, investors will receive income. This income is exempt from both federal or federal and sometimes state taxation, I should say. And so for this reason, munis are appealing to investors, especially those with high tax rates. The question is, so what do states and local governments do with that money that we effectively are lending them? Well, interestingly, the proceeds from municipal bonds are used to fund things like, airports, parks, bridges, really things that we see and use every day. And total, there's about $4 trillion outstanding in the municipal bond market. So it's very large, but again, probably not as visible to many people, and they're are appreciated to many people. As for the second part of your question, duration, it's a way of really measuring how long it takes to get paid back. And another important reason that investors talk about duration, and you might hear about it quite often, is it also it helps to indicate the level of volatility a bond price has based on interest rate changes. So in more technical terms, bond duration is really a measurement of interest rate risk. And the way we like to break it down as a general rule is for every increase in interest rates, say 1%, the bond price will change by that level of duration. So if you have a bond with a duration of 5 years, interest rates go up by 1%, the bond price will decline by 5%. And that relationship works in reverse too, if rates were to increase. So understanding bond duration can really help investors determine how bonds, not just municipal bonds, but all bonds might fit into their investment portfolio.
Yeah, because clients often talk about bonds as being safe, but we know that they have their own risks as well, and they are particularly impacted by these changes in interest rates. So it's been a challenge. for you working with that. And investors have a couple of different options, don't they, when it comes to investing in municipal bonds? What are some of the key distinctions between owning, say, an individual bond versus having a commingled fund like a mutual fund or an exchange traded fund?
Yeah, good question. There are a lot of options out there for investors, and I think there's a few important distinctions. So for investors, I think they really need to think about their own situation and what's the most important to them. So for things like liquidity, diversification, how much money they are likely to invest, are all really important considerations. So let me start with one, which is liquidity. A bond mutual fund or an ETF, as you mentioned, a commingled product is beneficial because it can provide daily or almost, in the case of an ETF, intraday liquidity. So if your client, picks up the phone and they want to liquidate their portfolio, their account, or excuse me, their holdings, their holdings in municipal bonds, sometimes an ETF or a mutual fund might be more beneficial because it often would take a long time to sell individual bonds into the market. Another important consideration is diversification. Here, in this case, mutual funds and ETFs are also very good. Most of these commingled vehicles hold hundreds of positions, so it really diversifies the risk to any one particular bond. Whereas an individual buying a bond, an individual bond would have to buy a lot of different bonds in their portfolio to achieve the same level of diversification. In terms of minimum investment, mutual funds and ETFs are also pretty appealing in that regard too. They tend to have very low initial investment hurdles. And then lastly, though, there obviously are some benefits if clients might want to work with you, like an advisor, to manage their own, buy their own bonds or buy them directly. They can get specific targets in terms of the time horizon over which they're looking to invest. They can target a certain sort of yield target or a risk profile based on the credit quality of those individual bonds they might want to buy. So end of the day, there really is no right answer. It really, depends on the unique situation of your investor. So I'd advise people that's when they pick up the phone and call their advisor and weigh all these variables.
Yeah, great. And so we've really had a volatile year this year. So what do you see, if you can get the crystal ball out just a little bit, what do you see in store for the municipal bond markets as we head to the close of this year?
Yeah, what we call in the business is our base case is likely a recession, a mild recession in 2024. The reason being, the largest reason being is this quick spike in interest rates. I think you're going to see it reverberate through the economy. It tends to take a while for those rate hikes to work their way in. Don't forget, a lot of us have already borrowed at lower rates and locked in those lower rates. And so only when we have to come back and reborrow or buy, make new purchases, do we really feel the impact. And that's the same for corporations as well. Within the investment world, I'm slightly biased given I cover municipals. I think municipals are going to hold up really well. State and local governments, like the private sector, receives massive relief and stimulus from the federal government. And then, as I mentioned earlier, rates we believe are at or near their peak in the cycle. And so for bond investors who are thinking about where to reallocate or allocate capital, we think it's safe and to probably increasingly call it dollar cost average or dip their toes into the market if they haven't already.
Well, thanks, Greg, for sharing some insights about the bond world. It is time for us to be wrapping up today. So what are your last thoughts, please?
Yeah, I do speak to clients most of my day, and I think they're one of the things they've been doing, some of them at least thinking about doing, is what's called tax loss harvesting. So they are looking to sell losses and use that to offset some taxes going into the end of the year. Clients also want to be in touch with their financial advisor, really to assess their personal situation, and really taking a back to basics approach, making sure you understand what you own is really helpful. So again, keeping a long-term perspective rather than reacting to short-term changes in the markets. So that's pretty much it. So thank you for having me, Deborah.
Yeah, and we are certainly keeping busy here with tax loss harvesting considerations for our clients. And thank you so much for all this great information. I know the bonds are kind of a mystery to a lot of people. And that's it for today. We hope that our listeners have found this helpful. If you had a question about anything that we didn't answer, please feel free to reach out to us directly at the office. We'll be posting this to our social media and our website, and next Elevation Market Update will be happening in the new year. Thank you.